This is the US dollar. All right, so the first thing I do after big numbers come out, I say, okay, what is the US dollar doing? And what we could see here is initially it spiked up, right? That was the initial reaction. That's like, holy cow, these numbers are hotter than expected. But then look at what happened. We've now come down, and the dollar is now trading lower than where it was prior. Now you might say, well, why was the dollar popping on hotter numbers? The answer is very simple. Because again, the hotter the inflation numbers, the thought process is the Federal Reserve will have to raise interest rates more, and that strengthens the dollar. But what we're clearly seeing here is that at least initially, the dollar has actually come down after basically a pop in the CPI, or in the hotter than expected CPI numbers. We saw the dollar pop and then drop. Smart money knows that the economy is going to start to weaken very quickly. No one's buying a house anymore unless they have cash, because again, why are you going to pay 7-8%? That's a huge mortgage payment, especially for a consumer that has $1 trillion in credit card debt and also leverage to the hilt, right? They spent down their COVID savings. Yeah, they still have jobs. But again, think about all the inflation we've seen. So you have a job, maybe you got a raise, a lot of people did, but it's all been eaten up because of inflation. And then you talk about home prices up here, mortgage payments even higher, and it makes it honestly tricky. Then you come around and you start looking at some of these other things. So think about all the jobs that the mortgage industry kind of deals with. And all of those are now dead in the water. Okay, so a lot of things going on here, and it's going to ripple through the whole economy. My guess is, and we'll see what the dollar is later today, markets have not even opened, but my guess is we'll see the dollar kind of stay in this upper range, maybe even come down a little bit more, but eventually, I do still think, if we go back to the daily chart of the dollar to me is overbought. Right, here's your daily chart. We were just on the intraday 10-minute. That's why you could see those intraday moves over the last 10, 20, 30 minutes since the CPI data. But now we go to the daily chart, and what we see here is a dollar that has actually had a significant move higher. And then look at this. See this candle right here? That's a reversal candle, and potentially we're starting to make a bear flag. And so again, you have to be open to this stuff. So many people are like, but the CPI, but this or that. Doesn't matter. Who gives a crap about the numbers? It's all about the reaction to the market. That's what's going to tell you what's going to happen, all right? That's what's telling you where the market is. And by the way, this doesn't mean the Fed is going to start dropping rates just because the dollar's coming down a minuscule amount. My guess is it's telling us that rates are here for longer, meaning they're going to stay up for longer, but the Fed is likely potentially done because economic news is going to be so horrendous in the next 6 months that they literally won't be able to raise any more. And that's, again, why you're seeing it stall out here versus with the CPI being hotter, it would anticipate a higher move in the dollar, and you're not getting it. Now, this is the 10-minute chart of the 10-year yield. What do we see here? Well, we were trading around 4.3%, right? Going into the number 4.35, somewhere in this vicinity. And look, initially, same thing. Big pop to 4.35% on the 10-year. And then, check this out. Look at that. Okay? Now we're all the way back down to 4.284% on the 10-year. Same thing. I don't think this means the Fed is going to come out and start cutting rates. That's not what this is telling us. What this is telling us is that the market, again, is starting to say, wait a minute. Yeah, numbers are a little hotter than expected on inflation. What that's going to do is it's going to keep rates at this level or thereabouts for a longer period of time. And again, that's why you're seeing this little reversion here. In all fairness, earlier this year, there were so many people saying, hey, by year end, they're going to cut rates. Not going to happen. Then it was, oh, in early 2024, they're going to cut rates. Not going to happen. Now, by mid-year, do I think so? If the economy stalls enough and starts to collapse, that's a possibility. I do think that if the stock market, for instance, drops 20% in a month, yeah, I mean, the Fed is human. They're going to panic. They're going to start cutting rates, even with inflation around this level, but they probably won't be able to lower it much. They'll throw a bone to the market. They'll say, oh, let me see if we can stabilize the market by doing a 25 basis point cut. They know deep down they can't go back to 2% or 1% on the Fed funds rate, but they'll do a kind of a throw a bone type event. So we go to the 10-year yield, and one of the things that I've been saying here is we have this top pivot, right? So we have a very clear resistance level on the 10-year. Pivot high, and pivot high. And now you're getting this little bit of a pullback. So my guess is you're going to start to see rates go in between this level and this level. And that's where we're going to stay for a decent amount of time because, again, Fed can't lower rates. Inflation's obviously too high, but at the same time, they're probably not going to raise rates. And you're just going to get this fluctuation based on what the economic data is. And slowly over time into 2024, economic data is going to go like this, right? Jobs data is like this right now, starting to weaken a little, and it's going to go like that. That's what I'm anticipating into the first and second half of 2024. Hotter than expected CPI numbers, but ultimately, what did we see? The market's not doing what most people would anticipate. Dollar fell and the yields fell, which again tells us something about what smart money is anticipating the economy will do. Next, we're going to take a look at the gold chart. All right, so initially we know this is amazing, folks, because if we go to the gold chart here, let me bring this up. This is your 10-minute gold chart. Initially, we fell, then we popped. Now we're basically flat on gold, right around this 1910 level. I'm curious to see where gold goes myself. Very, very curious. But again, if we go to our daily chart on gold, we continue to have, to me, a bigger pattern of consolidation, which is bullish on gold. So if we look at this, right, we know that we had the scene of the crime here, or we had the pivot point here, the pivot point here. We broke out. We touched double top or triple top at this point. This was your all-time high on gold, 2080. We tagged it back a couple times already, so technically this is a triple top. We then backed off, retested, but look at this pattern. Basically, you have a very defined wedge pattern development, which is a bullish wedge off of this up move. That's a flag. See the flag right there? Up move, and here's your flag. All right, in general, my anticipation is that we're going to start to break up here. We'll have a little resistance here again, but usually by the fourth or the fifth hit, you break out. And again, I think by early 2024, we are north of our all-time highs on gold. One thing I wouldn't want to see on gold, if we start trading down here, that would be not good. You'd break your flag pattern. As long as we stay here or higher, basically 1870, 1860 or higher, I think gold is hardcore bullish. And again, it anticipates what I'm saying, which is inflation will remain relatively